So today's topic is corporate governance and social responsibility. What is corporate governance? Governance is nothing but the act of the government which is governing the citizen. That means the government governs the citizen by what way? By making rules, regulations, and by the rule of law. So the act of government governing its citizens, the act of government governing or like controlling the citizens by rule of law is nothing but governance. Here we are not speaking about only about we are not speaking about the natural person, we are speaking about the companies, that is corporate. So the act of the government governing the corporate sector is corporate governance. So it is very important that all the companies which are operating should follow all the compliances. What do you mean by compliances? Should be following the rules, regulations, and laws. In this way, the companies can, like government can control the companies from, like doing any kind of acts which are forbidden by law. That means the companies can be checked and they can be stopped or curbed from doing any kind of illegal activities, right? And there are some social responsibilities even the companies have towards the society, not apart from generating employment. There are certain other responsibilities also they have. We will be seeing with the help of this chapter or topic. Now we in this particular chapter we are going to get ourselves introduced to the corporate governance. We are going to see what is the agency problem, developments in corporate governance, what are the best practices and the recommendations, board of directors, board members, non-executive directors. We'll see what is a board of director to a company, who are the board members, who are the non-executive directors, and there are certain committees which are formed in the company. So here we are going to discuss about remuneration and audit committee, then reporting. Then definitely there every company makes the financial statements at the end of the year. So you know very clearly what is financial reporting, but here we are discussing about reporting on corporate governance. So every year the company secretary of a company, the directors are the one who are charged with governance. It's their responsibility to see that company is complying with all the rules and regulations and laws. That means compliances. And the report will be made by the company secretary of a company, who is responsible for seeing all the compliances, whether the organization is complying with all the rules and regulations or not. Then we will be seeing about CSR, like what is the social responsibility the corporate sector have towards the society. And then we are going to see the approaches to social responsibility, ethical stance and analysis of stakeholders. Now, so I've given a very short introduction. Let's dig deeper into the subject. Introduction to corporate governance. Corporate governance, the system by which organizations are directed and controlled by their senior officers. Here I mean the board of directors is corporate governance. You know, what they are supposed to do is nothing but what government wants them to do. That's it, right? So the system by which organizations or companies are directed, so they give the direction and they control the organization in entirety. And who does that? The top level management, the board of directors. Definitely they are looking into a company and seeing that all the compliances are followed. Now let's understand about the agency problems. Now why agency problem? Who is an agent here? We will discuss about this. Principal, agent. Principal are nothing but the shareholders of the company, and agent is nothing but the directors. And the relationship what they have is principal agent relationship. Directors, who are the agents of the shareholders, are running the organization or company on behalf of them, and they have to always work in the best interest of the shareholders. So corporate governance issues generally arise from the separation between ownership and control in the organization. Ownership is with the shareholders and control is with the directors. So there, you know, a lot of problems. You being the shareholders being the owner cannot control the organization. They are just having a right to get dividends and share of profits, but all the decisions, everything is made by the board. So small organizations where owner and the manager are the same person do not cause corporate governance issues. That's what. See, if you are not running a organization directly and someone else is running on your behalf, and that too they are free to take any decision, lot of issues, a lot of, you will be having a lot of thoughts in your mind. I being the owner, I'm not able to run the organization directly. Then how the other person is running the organization? And there comes the corporate governance into picture. That means the one who is running cannot cheat you. Why? Because they have to run the organization by rule of law or follow all the rules and regulations, so that you always think you are on the safe side, right? Now, with larger organizations, the owners, that is the shareholder, and the controllers, that is the director and the managers, are not the same parties. Of course, their interest may diverge. Example, shareholders will want dividends and an increase in their value of share, whereas managers want higher remuneration and bigger status. So if you want more dividends, that is not possible if very high remuneration are given to the managers or directors, and you always want the increment in the value of shares. So if they give, the managers declare high packages and perks for themselves, that's increasing the expenses, and then that is not that's like not good for the company, because you get less profits and less retained earnings and less increment in the value of share. Or else, like if such kind of things are happening, the shareholders will be, potential shareholders or investors will be wary of the company, that very high remuneration. See, if someone delivers, if some employee deliver, if they can give $1 billion sales for company, $1 million payments are okay. But if they are not delivering, then again, it's a big question mark. So very high expenses can lead to lesser profits, lesser dividends. Okay, because less is left over, and also the value of the shares would not go high. Second factor of the in which the value of share won't be high, if they don't reinvest the money. When less is left over, maximum money is taken by them, then how will they reinvest? So the investments won't happen, the share value won't grow. Now, the agency concept is a situation where one party, the principal, hires another party, the agent, to act on their behalf. When applied to corporate governance, the shareholders are the principal and the directors are the agent. The agency concept is more relevant for larger organizations where there is a greater degree of separation between ownership and management. Management may follow their own interests rather than the owners. This is known as agency problem. That is what the management always think of their own interest. They want high remuneration, high perks, high salaries, and they ignore the interest of shareholders in that case, because they want to do favor for themselves, and there comes the agency problem. Activity 1, give some examples of actions that directors of large company might take if there are no controls that are not in interest of shareholders. Of course, they will not invest money into some good investments. They will increase the remuneration for themselves. These are the two problems I said. Some other problems, if you can give me, please tell. There can be a conflict of interest, right, between the shareholders and the directors. Shareholders want the directors to invest in high profit giving projects, which may be risky. Directors may not want to do that. Directors may not follow compliances at times. That they say that there are unnecessary expenses when it comes to compliances. Like if company is a big polluter, they have to bring some. They have to like set up some mechanism whereby they can, they can kind of recycle the waste, and which may cause less harm to the environment. But what happens? That there's a cost for that. Compliances have a cost, high cost. So they don't want to put all those expenses, and that may bring bad repute to the company. And again, the value of the stocks may go down in the future. So all these things are there. So you can frame your own answer in this case. And seriously, you have to submit that homework to me tomorrow on WhatsApp. I'll check it. I know some of the homework has been submitted in the previous past. I have reviewed them. You submit this, we'll have a discussion. Now, next comes the developments in corporate governance. See, corporate governance has become increasingly high profile over the last 30 years due to a number of factors, including See why there is a need of corporate governance, why the corporate sector should be governed by the government, or why the compliances are very important, or the rules and regulations should always be followed because of the high profile corporate scandals. You can see Wirecard, Parmalat, I can say Enron scandal in US. These are UK based companies maybe. Then Lehman Brothers 2008 crisis. There are many scandals are there. These are famous ones. When you see such examples, don't stick to only these words. You should be having more curiosity to check what was this scandal all about. So check in Google BHS scam or scandal, Wirecard. See, this is not the end. In SBL, you are going to again come across all this. There they'll be giving case studies also. So if you do good research, you become good student. Parmalat, Enron company scam, Lehman Brothers scam, Satyam scam in India. There are many scams, right? So you see what happened in them. You will understand. All are because they did not follow the compliances. Increasingly active and international shareholders. So corporate governance is very important now because the foreign investors also want to invest in the domestic companies. So they always are very much wary, and they think if compliances are not followed, the company which is operating in the country is operating in a very risky environment where compliances aren't there, and that brings a bad name to the nation or the economy as a whole. So India, many investors want to invest in India because we have very strong compliances in the companies. And see, scams have happened everywhere in the world. So you are no company is immune to scams. But the thing is how they have developed the mechanism or the strong standards so that they can curb these scams. That is more important. How you overcome these problems is more important. How you recover out of this is more important. Okay. So again, developments in corporate governance, the role of media, increasing media scrutiny, globalization highlighting business culture differences around the world. So if UK is following a lot of compliances and India is not following, that's not good, right? So every country, every economy wants to have best business culture or best kind of system. Developments in financial reporting, like the financial reports have become very developed these days. Lot of disclosures are required. The international accounting standards are very strong. IFRS, International Financial Reporting Standards, and International Accounting Standards, IAS. You'll be following them in FA and FR subject. These have made the things very, very strong. And now no one can, just write the things and the statements. They have to disclose a lot of things regarding the elements of financial statements. Then the Sarbanes-Oxley Act, which was enacted in the United States. In the US, the Sarbanes-Oxley Act was introduced in 2002. Companies listed in US stock markets must comply with the act. They should follow all the regulations of this act. So I said compliances. The main provisions of the act are, first and foremost, the majority of the board of directors must be independent. They should be working independently, right? Majority, independent, non-independent. Once, like they are saying, the independent directors are the ones on whom the restrictions are not there in the company. There are executive, non-executive. Executive are the ones who work on daily basis. Non-executive are only the ones who are a part of the board and they attend the AGMs, annual general meetings, and they give a lot of suggestions to the company. The CEO and CFO must certify that the financial statements are accurate. This is again one of the important points. Companies must form an audit committee to conduct audits made up entirely of independent directors, non-executive. Independent or non-executive kind of, right? Now, auditors must review and report on the effectiveness of the internal control procedures. So auditors are the ones who are supposed to do the auditing, and they are the ones who have to see that all the controls are intact. Public company oversight, PCAOB, was set up so that they can have an oversight or vigilance, or they can have a look into all the audit reports and accounting statements, whether the the standards are followed to prepare the statements or not. So here generally they speak about US GAAP, United States generally accepted accounting practices or principles, whatever you want to say. Then came the OECD principles in 1999. The Organization for Economic Development and Cooperation, OECD, published the first edition of its principles of corporate governance. These are intended to provide guidance for countries that wish to improve their corporate governance regulations. There are many countries in the world which are underdeveloped, right? So they want strong regulations to be like in reality in their country. So if they don't have certain mechanism, they can follow the mechanism. They can follow the guidelines of OECD. That means OECD can provide them the guidance how the countries can improve the corporate governance structure or regulations in their country, in their own homeland. And for the companies that wish to adopt best practices, so they always welcome this kind of things, and they are more handy and helpful for all this purpose. The most recent edition of OECD principles was issued in 2016. Just a second, just give me a second. Okay, so let's go ahead. Yeah. So we are into the UK corporate governance code, right?
Yes, sir.
So we were discussing about the independent and non-independent directors. Independent are the executive ones, and non-executive ones, sorry, and non-independent are the executive ones. So executive ones are working on daily basis, and non-executive ones, they don't work in the company. They are not into day-to-day operations, right? So independent directors are non-executive. UK Corporate Governance Code. UK Corporate Governance Code was developed over many years. In 1992, the Cadbury Committee on Best Practice made recommendations relating primarily to the structure of board of directors. The Greenberry Committee of 1995 looked at remuneration of directors, and they are keeping a very hawk eye on all this. Higgs report of 2003 dealt with the role of non-executive directors. The Smith report of 2003 looked at the audit committees. So these committees all looked into all these things, how much remuneration is given, and role of non-executive directors, and the audit committee. About the audit committee, they had a review. In 2003, these reports and committee recommendations were combined into the combined code on corporate governance. So the recommendations were given by the committee in 2003, and all those recommendations framed were nothing but combined code of corporate governance. Since 2018, it is now referred to as UK corporate governance code, should be followed by companies. UK code is principle based, not rule based, right? Cause and effect is properly considered principle based, which means it sets out principles of good governance, leaving it up to organizations to decide how to adhere to this principle. So principle based is not rigid one. When it is rule based, everyone has to follow. Principle based is nothing but they will be giving you. So they have all they'll give you the ideas. See what is right, what is wrong, right? So if it is not necessary for me to make rules and tell you what is right, what is wrong. There's a common sense thing. So if I am speaking on something which is exactly justified thing, so everyone understands, right? Like what is right, what is wrong, and everything need not be taught to every. So common sense things need not be taught, right? Everyone knows that. So accordingly you can act. That's what. So this is in contrast to the Sarbanes-Oxley Act in US, which adopts a rules-based approach. So US almost all rule-based approach you'll see. In UK almost all you see the principle-based approach. US GAAP in itself also is rule-based. They make rules you have to follow. They don't give you any kind of chance to have a thought process on that. So they say that we have done all the research, we have done all the brainstorming sessions, and we give you the rules. But principle based is they make principles. You can you can see what's right, what's wrong, and accordingly you can apply the things, right? So IFRS is principle based. For example, a small example I'll give you. See, interest paid. You tell me, interest paid should come in operating or financing activities. As per US GAAP, they say this should come in the operating activities. Rule based system. Principle based system doesn't say that. They are not rigid. They say, okay, you may have an idea about cash flow statement or not. Do you have idea about cash flow statement? Do you know how to prepare cash flow statements? Please tell me, or else I can give you another example also. Hello.
No, sir.
So you don't have an idea, right? So I'll give you a
No.
small example. Don't worry. Yeah, yeah. So I'll give you a small this thing. Another example. So if I give you a small example here, see, let's say this is IFRS and this is US GAAP. So I was just, let's say, if I started the example, let me give you the things. So when you make cash flow statement, you divide the cash flow statement into three activities: operating, investing, and financing. IFRS says interest paid can be, you decide what it is. They're not rigid about how to give the treatment to this interest paid. They say you can put this in the operating activities or financing activities. We are not, if it is justified that it is like, like you can take that in the operating activities section as well. You can take in the financing activities section as well. But US GAAP says no, we made a rule. You don't apply your mind. You only put this in the operating activities. You don't keep it in the financing activities because we gave that rule to you. That's it. So IFRS, you can apply your mind, but US GAAP, you should apply only the rules, what they say. One more example. IFRS says has nothing to say about how you can make a balance sheet. So it's upon you. You want to start with current assets in the first and then fixed assets, or if you want to start with fixed assets first and the current assets. US GAAP gives you a format. You have to rigorously follow that format. If they say that current assets would always come first and fixed assets next, you have to follow that. Finished. Did you understand now what I mean to say? Just to prove
Yes,
you.
sir.
That's what they say, you follow. So now poor corporate governance, what might the futures of poor corporate governance be? This is a question you should be answering. Where you can see poor corporate governance if compliances are not followed. So you can give, if there is poor corporate governance in a company, what is going to happen? Scams, scandals, less
Corruption.
and like that is very bad for shareholders, right? It's a threat for shareholders. So you can write certain points here. Now, next point. Best practice, the board of directors. We are into the second topic. See the board, if we see, you have executive directors, non-executive directors. These are the ones which are unindependent. These are independent directors because they have nothing to do with day-to-day operations of the company. They are just giving suggestions and recommendations, and they are the ones who are a major part of audit committee and remuneration committee. Audit committee is made specifically for conducting internal audit activity, and remuneration committee is for deciding how much remuneration should be given to the executives. Then chief executive, CEO, then chairman. Role of board. The director is someone who works for a company and is charged with conduct and management of its affairs. They are the one who conduct the duties, and they always have to see like how the company is functioning and how the management is performing its tasks and duties. Directors collectively are referred to as board of directors, who are elected by the shareholders. Stewardship theory links to corporate governance as it views the directors as stewards of the company assets on behalf of owners. Yes, they are the ones who are going to have run the company and look over the assets of the company on behalf of the owners. The role that should be taken by board has been much debated. For example, they may include major decisions such as mergers and acquisitions. Yes, they are involved in that. Without them, these decisions cannot happen. Acquisitions and disposals of major assets, very high value assets. They are only going to decide whether to acquire them or to sell. Any kind of investments, they are going to decide. Capital projects, very big projects, they are going to decide in big projects how much money has to be invested. And major borrowings, they have to decide. So they only have the power to do all this. Without them, no one in the company has the power to take decision on all this, right? Role of chair. The chair is the leader of the board of directors. That means the chairman. It is the chair's responsibility to ensure that the board operates very efficiently and effectively, promoting regular attendance at meetings. That means they have to attend the meetings also, right? The directors. That chairman has to ensure, and full involvement by all members. The chair decides the scope of each meeting. That means what is the meeting all for, and is responsible for ensuring that all matters are discussed fully. Then role of CEO. The CEO is the leader of the executive team and is responsible for the day-to-day management of the organization. So chairman chairs the board of directors, and CEO, all the executives who work in the company, he is the head of that. And he has to ensure that all the operations on day-to-day basis happens efficiently in the organization, as well as they attend the board meetings. The CEO will usually chair the management committee or executive committee. While most companies have monthly board meetings, it is common for management or executive committee meetings to be held more often. That is, in fact, in 15 days as well. Then the company secretary, who is a key managerial personnel in the company, has a very big role to play. You may be knowing about the CS course, company secretaries. So the company secretary is effectively the chief administrative officer, CAO. So they are the chief administrative officer and is appointed by the company's directors. They are legally responsible for acting on company's behalf to undertake specific requirements. So they are legally, as per law, they are responsible for acting on company's behalf and to undertake specific requirements. Duties which fall under the remit of company secretary typically include filing the company's financial statements and annual return with the company's supervisory authorities. Who supervise the companies? The registrar of companies, right? And also the regulatory bodies like in India we have SEBI and in UK you have Stock Exchange Commission. Maintaining statutory books and records, the ones which as per law you have to maintain, that is register of directors and shareholders and many charges held on company assets. That means on some of the assets which are taken on, like by charge on company assets is nothing but you have the assets are purchased, but the papers are not with the company, that is with the bank. So there's a charge on those assets. That means the amount has to be repaid. Safeguarding all the legal documents, including share certificates, certificates of incorporation, and other official documentation. Organizing board meetings of shareholders and taking formal minutes. That means whatever happens in the meetings, the minutes of the meetings have to be recorded. That means every minute what decision is taken, they will be recording all that. That role they have to play. In addition to these duties, the company secretary is required to establish and maintain a registered office for official communications. Board members, corporate governance codes in a number of countries have made several recommendations in relation to the board, including the following. So, corporate governance codes in number of countries have made a lot of recommendations in relation to the board. And like in many countries, almost all the countries, corporate sector is there, and the corporate sector have to be governed. So corporate governance codes are made or framed in different countries, and they have given a lot of recommendations in relation to board. The following are: in individual directors should have relevant expertise for the role which complement each other. That means the role for which they are known, they have to perform that duty. That should complement, right? That should not make the things complicated. The board should receive appropriate information in a timely manner which is sufficiently clear, including non-financial information as well. Performance of board and its members should be assessed annually, example by the shareholders, and the role of the chair and CEO should be separated to prevent domination of board by one person. The chairman cannot be the CEO. Actually, it shouldn't be the case. There is a separation of duty, which is important. CEO should manage the functions, and chairman should only be the one which should be chairing, doing the chairmanship for the board, only involved in making strategies. I will make the strategies, and I will only implement, and I will only decide what remuneration should be given to me, and I will only do everything. That's not possible. One person cannot do all the things and cannot try to reward himself for what he's doing, because separation is important, right? Then comes the non-executive directors. There's a real life example also here. So non-executive directors have no management responsibilities. I already told you they are not involved in day-to-day operations. It is intended that they act as a balance to executive management and advise the board on issues such as strategy. So they play advisory roles. They advise the board on issues such as strategy, performance, risk and remuneration of the executive directors. That means what risk can be there to the company and how much remuneration should be given to the directors, right? They are more into advisory roles. They are experts. Non-executive directors can broaden the experience and perspective available to the board and can offer reassurance to shareholders and other outside parties. That means based upon their assurances, the shareholders would be kind of, feeling confidence and feeling confident to continue with the company and not selling the shares, whenever there's a crisis or whatever. These non-executive directors play a crucial role to ensure that the confidence is retained in the organization, making people to believe. Non-executive directors must be independent of the company. For example, they are not expected to have business or financial connections with the company and have limited time appointments. In certain countries, concept of non-executive directors is taken further. For example, in Germany, all public companies must have two-tier board. The management board comprises executive and the supervisory board comprises non-executive directors, partly elected by shareholders and partly by employees. Go for the activity 3 after reading this. See, these activities are something which you can do, so I'm giving, otherwise I wouldn't have given to you. How many units are there in this? 3 units. Okay, how much time we have spent? 34 minutes. Next comes, so there's a real life example. Philip Green, a British retailer, acquired the BHS. So we have seen right now, right? What scam happened? A retail chain for 200 million pounds in 2000. He sold it for £1 in 2016. See, you know, in Russia-Ukraine war, what has happened? Many companies, they sold their assets for $1. That's it. They wanted to run away. So the British retailer acquired, Philip Green is a British retail company. They acquired some retail chain for this much amount, but they sold it for this much. You know, like, because in 16 years, that much losses they have incurred, and they become bankrupt. A date when Mr. Green sold BHS, the company's pension fund was running a deficit of $571 million. My God. That means that much they have to pay. The bankruptcy of BHS and the pension deficit were due in large part of the fact that during his period of ownership, there was little investment in the stores of the pension fund. While Mr. Green's family received dividends of 400 million pounds, that's what the biggest scam. They did not put the money in that. Actually, if employees are working in the company, what the company should do is, whatever the employees are earning, out of that, some portion should go into the pension fund. There can be some contribution of the employee and there can be some contribution from the employer. But what they have done is, they did not put the money, okay, and instead they were like, you know, drawing a dividend of this much, right? A report by UK Parliamentary Committee into the affair reached the following conclusions. We saw meager evidence of type of constructive challenge that good board should provide. These weak governance, that means they are taking the money for themselves, but they are not putting the money in the pension fund. The weak governance arrangements allowed the overarching interest of Green family to prevail and facilitate the flow of money offshore to the ultimate owner of the parent company, Lady Green. That means they are withdrawing money from the company, but they don't want to put the money in the pension funds, which legally they have to do. They are not following the compliances. That is rules and regulations which they have to follow to avoid any kind of discrepancy, and this has led to a big scam, the company going bankrupt, right? Who will suffer? The shareholders will suffer. That's it. Remuneration and audit committees. I already explained you that remuneration committees for deciding how much remuneration should be given to the top level executives, and audit committee is to conduct the audit in the company. Non-executive directors can exercise oversight. They can overlook of executive directors by operating through committees of main board. That means non-executive directors can, you know, have a look on the executive directors functioning by making certain committees of the main board. These may include key areas of board activity, including audit, senior managers remuneration. That means some important functionalities are to be performed in the company. So they make committees and they look into all this, like audit, how the audit is conducted, and senior manager, how much remuneration they have to be given. About the risk management, they have risk directors in the company, and also about the senior appointments. You only need to know about the role of the audit and remuneration committees for your exam. We'll discuss this. So let us now run the class for some more time. This box we will do today. Then rest part we can finish tomorrow. Not much is left over. Tomorrow I can wind up this session. How much is left over? Okay, we will see. I will close this chapter today at any cost. Now, the following table summarizes the key information about these two committees. So the table is here. First, membership. Remuneration committee, audit committee. In remuneration committee, 2 to 3 non-executive directors should be there. In audit committee also 2 to 3 non-executive directors, at least one of whom must have recent relevant financial experience. That means in audit committee they should have the financial like they have been, they should have worked in some making financial reports and all in that area. Remit, remuneration policy and specific packages for executive directors and senior management. That's what they do. These people look into internal controls with the organization, liaison with external auditors, oversight of internal auditors. That means they are the external auditors are going to come to the company and do the audit. So they are the ones who are going to, interact with them on company's behalf. And also they keep a strong, oversight on the internal auditors, how they are performing their functionalities. Key objectives, procedures for determining remuneration and are formal and transparent. An independent channel is available to report any control issues. Like any problem can be given, they can be, approached. Bonuses should arise from achievement of measurable performance. See, bonuses are not declared like that. If you perform well, then the bonus. Resolving any auditor recommendations and auditor management disputes. So any dispute the auditors have or any problems they have, these people can resolve. All board remuneration and benefits are transparent in statutory accounts. They will keep everything very clearly, how remuneration is paid to the board of directors and on what basis. Financial and control systems in place are adequate, including an effective internal audit function. Remuneration packages align the interest of management and shareholders. That means the remuneration packages, what they recommend or what they, suggest is not against the interest of the shareholders. They will be also satisfied. Such kind of packages they want to be given. They want the company to pay to the executives. Adequate risk monitoring is in place. Reporting on corporate governance. Companies listed in stock exchange may be required to provide information on corporate governance compliance reports. That means, example, the following are a requirement on London Stock Exchange and derived from the UK Corporate Governance Codes. So a narrative statement of how principles of corporate governance code have been applied. So they should give this statement. The statement of compliance with code throughout the accounting period or reasons for non-compliance in written. Information about board of directors, committee reports, example, remuneration and audit committees, which we have seen right now what functionalities they have. Statement of effectiveness of internal control. So all this they have to prepare a report of, okay, and share with the authorities who regulate the companies. That is the requirement of the London Stock Exchange. If you want to list yourself, you have to show the reports. And they are not giving this from their side. They have derived this particular thing from the UK Corporate Governance Code because that code requires. So London Stock Exchange wants to implement that code. There is a question here. I know the question is very big. Governance issues. What are corporate governance issues at TechPoint PLC? After reading the chapter, you will be coming across this question. In this question, there may be certain aspects which you'll be seeing that is not going well with the corporate governance code. That means you may be seeing someone is a CEO and also the chairman, or they may, some contracts have been given to the relatives or something like that, which is against the which should not happen. Some audit related activity, something or the other will be there. You should be going through this and you'll be trying to giving your answers on this. Okay, I've given the hints. Or maybe higher remuneration is taken by the directors themselves. They are deciding how much remuneration, and they are only like fixing that. So there's no committee in like in the company, maybe such kind of thing. So you have to give your suggestions. You have to check what are the issues in this company and write some points regarding that. CSR, corporate social responsibility. The idea that organizations, especially but not only companies, have an obligation to consider the interest of customers. See, it is not only the companies. Every business should act in the best interest of their customers, their employees, their shareholders, the community at large, the society, and the ecological considerations in all aspects of their operations. Approaches to social responsibility. See, proactive strategy, taking full responsibility for its actions. See, you should not be polluting the environment. You should be doing good for the society, planting trees, making some footpaths for the people in the society, because your company is from the people, right? So not only employment, but do something for the society betterment, like making some hospitals, some etc. like that. Reactive strategy. So waiting until there is public reaction before amending the company's ways. Defense strategy. So they react only when they see that some outcry, and here they take full responsibility. Defense, attempting to avoid additional obligations caused by a particular problem. They want to defend themselves. Accommodation strategy, accommodating concerns of public and governments to prevent stricter legislation being introduced. Pros and cons of CSR. See, some arguments for and against companies embracing CSR are: for CSR, against CSR. Power. Large companies can be very powerful and they are not democratically accountable, may infringe on others' rights if they do not exercise self-restraint. So they want themselves to be in this. So, they're very powerful, but they should not misuse that, right? And so they want to keep themselves in a very controlled environment so that they may not infringe others' rights. So they want to keep themselves in restraint. Again, CSR companies can benefit societies most by operating efficiently and maximizing wealth for shareholders. So again, CSR means, see, everyone wants benefit and profit, right? But not the companies, they say that if we follow all this CSR and follow a lot of we do something for the society and we are compelled to do, and also uh, like uh, we may not be able to maximize the shareholders' wealth. Okay, so companies can benefit societies most. So they say that we can benefit the societies if we are operating very efficiently and maximizing the shareholders' wealth. So why we should follow CSR? Are you understanding what I'm saying? Hello?
Yes, sir.
Hello? Yeah, why to take CSR and why we should not take? So why to take? Large companies want to keep themselves very they want to control themselves, like they don't want to go beyond certain limits. But here they say that why we should follow when we are doing good job, right? Infrastructure, companies depend on society's infrastructure to function. That's what they say. When society is doing something for us, why shouldn't we do? Taxation, companies already fund society's infrastructure via taxes. So why CSR? See, already we are paying taxes, right? And those taxes are used by the government for publics or people's creating amenities for the people. Then why CSR? Externalities, a company's operations may have social and environmental consequences which need to be addressed. Example, pollution, environmental damage. So they say that because of us, a lot of things are happening and people are suffering. Sovereignty, it should be up to shareholders to donate to charities if they wish to, not for companies to undertake charitable activities. Very clear cut stance. Public relations, adopting corporate social responsibility can result in better image and greater customer and employee loyalty. Yes, because companies doing something for the society. Why? We give dividends and we increase their shareholders value. Then why? Then last part of the chapter, we are going to wind up this. Ethical stance. Ethical stance means the position that a person or organization takes when faced with ethical questions. Ethics is what? Having the knowledge of good or bad. That means what is good, what is bad, you are knowing. So what is your ethical stance? That means what will be your answer on certain questions when you face which are related to ethics. The range of ethical stances as described by Johnson and Scholes 2005 includes short-term shareholder interest. So organization is responsible for its ethical stance in short-term interest of shareholders, but the government has a wider long-term remit. That means companies want to give short-term, they want to give a lot of things to shareholders and immediate profits to shareholders. But for that they can do some unethical acts, right? Government doesn't want them to do that. Long-term shareholder interest, the organization takes a wider view of its ethical responsibilities by corporate image enhancement. That means in long term they can do this thing, right? And presentation of pressure for legal regulation. Multiple stakeholder obligations. The organization accepts the legitimacy of expectation of shareholders other than shareholders. Stakeholders. Stakeholders is a broader term. It's not only, see, shareholder is one amongst the stakeholders. Customers. Stakeholders are connected parties. Customers and government and lenders. Okay, creators, suppliers, all these are stakeholders. So multiple stakeholder obligations. Organization accepts the legitimacy of expectations. Like, yeah, it's very much understood fact that stakeholders want something from the organization, right? Not only about the shareholders. Shaper of societies, there is more demanding role that multiple stakeholder obligations and is largely the preserve of public sector organizations. Analysis of stakeholders, CSR can also be viewed within the context of stakeholders of the organization and the extent to which it meets the needs of the different stakeholders. So corporate, see, social responsibilities, the companies should take the social responsibility. If they are polluting the environment, they should be planting more trees, doing more for the society, give more better products to customers and everything. Like, apart from employment generation, paying taxes to the government and all, they should do something from their side. Okay, like some CSR initiative taken by Aparna group by making some park in the high-tech city vicinity or some area. I have come across that. Aparna Group Constructions has made that one of the examples. Not only they are paying taxes, generating employment, giving employment opportunities to people and many other stakeholders to whom they give some contracts and other things. But they are doing for this. They are making parks for the refreshment, recreation, and of the people, and that is also a part of CSR, right? They're doing. Why should they? Why will they spend all that money for that purpose? But it is their like they are thinking that they have to, they are making so many buildings and a lot of pollution and all these things will be there, so they wanted to do something good for the society, and with the parks and what they make, they want to become a contributor to the society, right? By making the health of the people more like rejuvenated, and making people healthy by making such kind of parks. So we are done with the chapter number 8. We will start the chapter number 9 tomorrow. Okay, thank you so much.